rates. Let's bring in Alex Morris, CIO at FM Investments. What are you blaming, Alex?
Well, I think I'm going to blame that it's tax day in the U.S., and nothing seems to be more American than waiting to the last minute to file or extend your taxes. So if any luck, it's just a bit of that bearish sentiment hitting the markets. I think in general, though, geopolitics tends to play a great role in everything we do day to day, but the markets tend to be a really bad predictor of what those news articles are going to mean. So I don't look at today as a response to what happened over the weekend or any other metric. Rather, more that many of the large tech names are momentum names, and momentum stocks do need to take a breather from time to time. And I think we're seeing that in the restructuring that happens when they do take a stop to have a rest.
I do want to pick up on your point about it being tax day, because that's actually a pretty well-documented phenomenon, right? That you do see equities move lower. And if you think that is the real reason, does this mean you don't really think that this is the beginning of a correction or that cracks are forming if you are a bullish investor?
Well, I, like everyone else, was standing at the post office for a little while today doing the thing that no one wants to do. And sure enough, some things had to be sold to send my money back home to Washington, D.C., a few miles where I am right now. And there certainly are some cracks, in both the financial and the real economy. But I don't think that today is the start of any of it. There's no other great indicator. The banks, as you said earlier, are really healthy and doing exactly what the banks should be doing in this market. And Tesla and some of the names that are taking, a retraction are names that have run up substantially far with growth rates that were really unsustainable, into the long term. And those names in general go through a cyclical process of reevaluation, repositioning, and then rapid growth. And I think this is what it looks like when you see some of those names at the same time go through that same cycle realignment. So
gold at record highs, bond yields selling off, the U.S. dollar rallying. You don't think these are warning signs?
But obviously, they're all warning signs for something. The gold rally is an interesting mark. We've been looking at gold in the portfolio, added 6 months ago or so, and its rally seems to have taken off. I suspect if we were hipper, we would look at Bitcoin as a hedge. We just weren't that hip, so we went with gold. But the gold price going up and the dollar coming down and rates moving where they are all seem to pretty much hold together with the story of a strong dollar and what really tends to happen when you see assets start to get volatile again. To me, the warning side would be if we saw the VIX or some other true volatility measure spike at the same time. Then we would risk a true correction. Not necessarily today, but in the coming 6-8 months, that would be the harbinger of it. But I just don't see any of those other points to get us, to that tipping point. There's just a lot of things that independently should mean something, but so far the markets as a whole have opted to just keep on trucking, as it were. And so far it seems to be working. And we can't expect every day to be green. And if a washout day still is only 180 points down on the worst of the three indices, that's not such a bad washout in many respects.
The VIX did spike a little. It's still under 20. When do you get worried?
I get worried when I see that start to hit over 30, certainly over 35. That's when we start to see things that are a standard deviation above the average and the 5-year, 10-year historic norm. I mean, things under 20 and certainly under 12, where they had been for a very long time, was just the sign of a very sleepy, low volatility market. And this is what happens when it picks up. Certainly Goldman's trading revenue is proof that there is some volatility that's coming back to the market. Today's spike, may be something that will continue. But I wouldn't be surprised if we saw VIX south of 15 or 12 again in 2 weeks, and much of today was forgotten.
Does your thesis, is it predicated on a view of rates? I mean, I know all of our views are predicated on a view of rates, but, June being a rate cut option, or does September? What if we get no rate cuts? Can you be constructive and not get any rate cuts?
I think we can still have some constructive element to the economy this year without any rate cuts. It's a strange scenario, and I wouldn't put a lot of faith in that. I think the Fed has been very prescriptive, that they see enough that they will want to cut rates, and they've spent the last 2 years rebuilding credibility of their narrative. So they will want to make something of that nature happen. They've never told us how big those rate hikes will be, so they might be baby ones, cuts. But I do think they want to cut Some, and they want to make sure that they're not going to break the economy to do that. We've never been in the camp that that would happen in Q1 or Q2. We've always thought it would be Q3 and Q4 and the far end of each. So far, I think we're still aligning with the Fed's narrative. Certainly, these economic indicators coming in hotter than expected is causing some reason for pause. And I think there, the real question isn't what does the Fed want to do? It's what will inflation ultimately force the Fed to do? And I think we're going to have to watch that through commodities prices. What does happen to gold and copper and palladium and wheat? And if we see broad inflation measures, which we know will ripple their way through the economy 6, 12 months from now, that's when we really do need to get worried about the Fed not being able to act, or the very, very rare scenario where they might have to actually hike again. Although I think that decision is months away from needing to be contemplated.
So the takeaway is you're still constructive. You're not panicked by the recent weakness that we have seen. Where are you putting that into practice? What are areas of the market that you find attractive right now, or that you would find attractive on a dip?
So we like buying the dip for tech stocks. We think they've kind of run their course for a little while, but they're going to be attractive if they lose another few points to kind of come back. We also like the short and mid end of the curve, of the U.S. yield curve. It's hard to not look at 5 and change and say that that's a bad investment. It is. We like adding some duration there as well. And contrary to most folks' view and fear of bonds, we like short-term and intermediate-term investment-grade bonds. There's a lot of opportunity there. And I think what folks tend to forget is they look at the yield changes and they get worried, but most of us are buying fixed income for just that, the income part. And in the IG space, the coupon rates have reset to 3s and 4s and sometimes above that. And that's a pretty healthy rate of return on what is highly rated investment-grade debt that we'd like to hold on to, and it gives us some cash flow to be more nimble in the future. The one item, though, in all of our portfolio is when we hit times like this, we really like to favor liquidity. It's really important to stay liquid and stay very specific on your exposure points, because that's where over-diversification, particularly that you don't know you're taking up, or limited liquidity will start to bite. When things change, you want to be able to move quickly, and that's where we're keeping everyone positioned today.
The sell-off has been particularly prominent in small caps, where the S&P is only down about 3% from its peak. Russell 2000 is down about 7%. Would you take a look at that?
Certainly, we do have a small cap portfolio, and we think it's a great time to really diversify away from the Fab 4 as it is now, the Mag 7 as it was a few weeks ago.
Yeah, they're getting picked off.
I'm losing track of. We're going to be down to just Microsoft soon enough, just as it was 20 years ago. But certainly a good time there. The small caps, though, I think folks really should take a look at, and that's one of the parts of the portfolio you're going to buy and you're going to hold for a while. You are waiting for that premium to return to the market. We think it will. We think there's some great opportunities in small cap, and that's where you do really need to be specific, though, where we like bringing in a manager like some of the folks on our team, because there is a lot of alpha to be gained from really being plugged into that world. The information spread in the small cap space just isn't the same as the large cap space. So you really do need to do your research twice as hard than versus, say, the